All right, let's jump right into this masterclass explainer. Today, we're putting on the hats of an expert investment analyst to perform a complete top to bottom stock analysis on Everforth Inc. We're going to break down this fascinating company using the legendary valuation frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, alongside some rigorous quantitative modeling like discounted cash flow. So, if you've ever wanted to know exactly how the greatest minds in investing would price a highly debated stock today, you are in exactly the right place. Let's get to work. Here is our roadmap for the analysis. We'll start with a completely objective snapshot of Everforth, just to get our bearings with the data. Then we'll run those numbers through the distinct philosophies of our investing gurus. After that, we'll build a formal DCF model, look at alternative multiples, and finally synthesize the whole thing into a definitive verdict. Section 1. Everforth Company Snapshot, the transition story. Let's establish exactly what we're dealing with when it comes to ticker symbol EFOR. Make no mistake, Everforth operates at a massive scale. They're a leading tech and talent platform generating roughly $4 billion in trailing 12-month revenues. Their business is split about 70-30 between commercial clients and the federal government, and they're currently pulling in around $413 million in adjusted EBITDA. So right off the bat, we're looking at a heavy hitter. But digging into the hard data, things start to get really interesting. The company is trading at $20.04 a share, giving it a market cap of just over $835 million. But wait, look at that total equity line, $1.79 billion. That is a massive asset base. Of course, that comes with a significant catch. They're also carrying a heavy total debt load of $1.46 billion. Keep these numbers in the back of your mind because they are the foundation for everything we're about to do. Moving to Section 2, the Buffett and Lynch lenses, moats, and categories. What's absolutely fascinating here is how two total legends of the investing world, Warren Buffett and Peter Lynch, would interpret this exact same set of numbers. Applying Buffett's rigorous criteria, well, Everforth frankly struggles out of the gate. In the highly competitive IT consulting space, their economic moat is developing at best. You know Buffett demands consistent earnings and high return on equity, right? But Everforth's Q1 net income dropped over 73% year over year. That leads to a very low annualized ROE of around 1.2%. Plus, their net leverage ratio sits at 3.1 times, which is definitely a bit too high for Buffett's taste. But hey, do not count the Oracle of Omaha out just yet. Buffett absolutely loves what he calls owner earnings, and let me tell you, Everforth is a cash-generating absolute machine. They have produced nearly $2 billion in free cash flow over the last 6 years, including $291 million in the trailing 12 months alone. Because of the earnings instability, Buffett would demand a massive margin of safety before buying, but that level of free cash flow would definitely, for sure, have his attention. Now, looking through Peter Lynch's eyes, we'd likely categorize Everforth as a classic turnaround or asset play. They're actively shifting away from legacy staffing into high-margin solutions. To calculate Lynch's favorite metric, the PEG ratio, we have to make a slight assumption. Because Q1 earnings were unusually low, we'll assume a normalized earnings per share of $1 and use management's projected 5% growth rate. That gives us a PEG ratio of 4.0. Lynch would consider that overvalued purely on a growth basis. However, their massive $1 billion share repurchase program screams insider confidence, which makes this a cautious hold for Lynch until that top-line growth actually accelerates. Okay, Section 3, the Benjamin Graham lens, deep value and margin of safety. The real crucial point here is how the father of value investing himself would price these incredibly cheap, tangible assets. Let's find out. We'll start with Graham's famous defensive investor checklist, and it is a pretty brutal assessment. Everforth passes on adequate size, but it fails on strong financial condition because of the heavy debt. They fail on earning stability, and they fail on dividend records since they don't actually pay one. But they pass the price-to-book ratio test with absolute flying colors, trading at just 0.47 times book value. To find the absolute floor price for the stock, we can calculate Graham's intrinsic value using his classic formula. It's elegantly simple, taking the square root of 22.5 multiplied by the earnings per share and then multiplied by the book value per share. Again, assuming a highly conservative normalized EPS of $1 and utilizing their massive book value of $43.65 per share, Graham's formula yields an intrinsic value of $31.33. With the stock currently trading near $20, you are looking at a massive 36% margin of safety. Graham would be heavily scrutinizing this as a deep value buy today. Section 4. Discounted cash flow valuation. Let's move over to the quantitative side and build a DCF model to see what Everforth's future cash streams are actually worth in today's dollars. Building this DCF basically requires 4 clear steps. First, we forecast the free cash flows using our trailing 12-month figure of $291 million as a base. Second, we determine a terminal value for the company into perpetuity. Third, we discount those future values back to the present day using the weighted average cost of capital. And fourth, we strip out that net debt to find the true equity value. Now, for our model's assumptions, we're going to transparently use the company's own target, a midpoint 5% growth rate for the next 5 years. For the long term, we'll assume a standard 2% perpetual terminal growth rate and an industry standard 10% weighted average cost of capital, or WACC. Running these numbers through a sensitivity matrix yields some truly fascinating results. Our baseline assumption, right in the middle, a 10% WACC and a 2% terminal growth rate, implies a fair value of exactly $58 per share. And look, even in our most pessimistic scenario, a 12% discount rate and just 1% terminal growth, the model still spits out $32.50, which is still well above the current trading price. Section 5. Alternative Valuation Models, Multiples Comparison. Let's take a quick look at how Everforth is priced relative to the rest of the market using a couple of alternative valuation multiples, really just to cross-check our DCF. Let's start with enterprise value to EBITDA. Factoring in their $835 million market cap, adding the debt and subtracting the cash, we get an enterprise value of roughly $2.15 billion. You divide that by their $413 million in adjusted EBITDA, and Everforth trades at a multiple of roughly 5.2. In the tech and consulting space, the industry norm is closer to 10, so this indicates a heavily discounted valuation. But perhaps the most staggering metric we found in this entire explainer is their price-to-book ratio of 0.47. This literally means the market is currently valuing Everforth at less than half of its total equity on the balance sheet. If you theoretically liquidated the entire company today, paid off all the debt, and just sold the assets, it would be worth more than double what it's trading for right now. Crazy, right? Section 6. Synthesis and Final Verdict. We've viewed the data through qualitative guru lenses. We've run hard quantitative DCF models, and we've checked the multiples. Now it's time to bring the whole shebang together. Bringing everything into a synthesis matrix reveals a very clear pattern. Every single valuation methodology we applied indicates that Everforth's intrinsic value is significantly higher than its current trading price of $20, from Graham's highly conservative $31 all the way up to an EV to EBITDA mean reversion of around $68. The math simply screams that this stock's cheap. However, we all know spreadsheets don't tell the whole story. The upside potential is firmly anchored by that incredibly strong cash flow and the deeply discounted asset value. But the realization of that value is constantly threatened by that $1.46 billion debt burden, the volatile recent earnings, and the broader macroeconomic headwinds that have been pressuring their federal segment lately. It's a tug of war. So synthesizing the data, Everforth is a clear buy for aggressive, deep value investors. It is acting as a classic Graham-style asset play right now. If you follow Benjamin Graham, that 36% margin of safety triggers a buy today. However, if your style leans closer to Buffett or Lynch, you would likely hold and wait for the fundamentals and the return on equity to stabilize before taking a position. So I leave you with this final provocative thought to consider. When a company's cash generation is this staggeringly strong, yet its market price is this distressed relative to its book value, are you looking at a classic value trap or the ultimate margin of safety? Take these frameworks, weigh the risks, and decide for yourself.